So let's look at another question to understand exactly each and every concept on why the particular things are dealt with in this pattern. First, January 2009, ABC grants 300 options to each of its 500 employees and the vesting period is 3 years. So we have this service condition of 3 years. Exercise period is another 3 years. So once the vesting period is over, they have the option to buy these shares for the next 3 years. So even if they are in the with the company or not with the company, it doesn't matter. The only condition is you have to be with the company for the first 3 years, vesting period. Total contractual life is 6 years, expected life is 5 years. Now we are expecting, though we have given them 3 years, within 2 years they will exercise the option and done with. Exercise price is 100 and market price on that date is 100. It is not intrinsic value. You can buy the share at rupees 100 while market price on that date is 100. It doesn't matter to us what was the market price on that date. So we ignore this price. Fair value of the option is 30. So if the fair value of the option is 30, it means that intrinsic value should be 130. That is why fair value of the option is 30. 30 is the expense for the company. Expected forfeiture first 5% per annum over the period of 3 years on grant date. Now we never check what happens on grant date, but whatever data given, we'll write it down on a timeline. 5% per annum at the end of year 1, 10% per annum at the end of year 2. Actual forfeitures 6% during year 1. Actual number of employees who completed the service is 300. So we had these 500 employees with 300 options each. So first is the grant date, when we have 500 employees, each of them are given 300 options. Fair value of the option is rupees 30 and forfeitures. So with F I mean forfeiture. Forfeitures expected are 5% per annum over the period of 3 years. At the end of year 1, actually 6% employees have left is what is told to you. So the employees left are 470. Option still remains the same. Expected forfeitures are again 5% per annum over the period of 3 years. Fair value of the option is not known at the end of first year. It doesn't matter. We are going to consider 30 rupees only. At the end of second year, we don't know how many employees are there, but expected forfeiture turns out to be 10% per annum over the period of 3 years. So you should understand the language. Over the period of 3 years is what they are saying again and again. Why over the period of 3 years again and again? Why are they using this language of over the period of 3 years again and again? See, suppose the company had these 500 employees. At the end of first year, 50 employees have left. That makes it 450. At the end of second year, 10 employees have left. That makes it 440. And at the end of third year, let's say 30 employees have left. That makes it 410. So ultimately 410 employees have left. Over the period, 90 employees left. Let me give you an average that 30 employees will leave per annum. Simple average. 30 employees per annum. 30 employees per annum. Simple average. Okay. 30 employees out of 500, if I try to determine, it is almost 6%. Simple average 6% per annum employees are going to leave. This is average. At the end of first year, what happened is, if you see 10% employees have left. And there is an average given to you, 6% per annum will leave. So as an auditor, whenever you visit the company and you tell the company that what are the number of employees that have left, 50, so it is 450. Fine, what are the number of employees expected to leave? Because employee based payment will be booked on expected number of employees. So they tell you our expectation is same 6% per annum over the period of 3 years. Simple average. 6% per annum over the period of 3 years. Simple average. And now why am I using the word simple average? Because I will change this word later. So I am just explaining you the terminology. So what do you mean exactly by this is they will tell you that we are expecting that from the original 500, 6% per annum will leave, that is we are expecting 410 employees will exercise the option. So now to determine this 410, should I deduct 6% from 450 over the remaining 2 years or from 500 only for the remaining 3 years? Because if you apply this 6% now to 450, if you apply this 6% per annum, that is 27 employees. So from 450 we deduct 27 2 times makes it 396, but we are expecting 410, so the average turns out to be wrong. We should deduct it for 3 years from 500 only. But the word that I used is simple average. It is never like that. You are never given a simple average. You are given a complex average, compound average. Now what is the compound average? Let me give you the compound average as well. Okay, I just need your minute to calculate this compound average. Okay. 6.4% per annum average over the period of 3 years. This is average. Now how was this average determined? This is a compound average. So from 500 we are expecting 6.4% employees to leave. I deduct 6.4%, that makes it 468, 32 employees. Now from 468 we will deduct 6.4%, which is 30 employees, somewhat round figure. So 468 minus 30 makes it 438. From 438 we again calculate 6.4%, which is 28, and if we deduct it, that makes it 410. Okay, so now 6.4 is a compound average. Normally this is the average that is given. Now if you read this question, the question tells you that we are expecting 5% per annum over the period of 3 years to leave, and the actual number of employees are 470. Now where should this 5% be deducted, from 500 or from 470? Answer is from 500 and not from 470. Why? Because the average is for 3 years period. Original average based on that 500, not on 470. So we try to determine this average. This average will be expected employees 500 multiplied by 95%. That is what we have to do 3 times, right? 95% to 95% to 95%. That makes it 428.68 employees. I am rounding it off to 429 employees because employee cannot be in fraction, right? So these employees multiplied by options. So the expense to be booked will be 429 employees. Each employee has 300 options. Fair value of the option is 30. The expense is to be booked over the period of 3 years. So 429 for 300, 30 divided by 3 years, 12,87,000 is the expense that we will book at the end of first year. I hope it is clear. From second year, the expectations change. What are the change in expectations? Number of employees expected to leave are 10% per annum, but again the average is calculated for 3 years, over the period of 3 years. So we need to again calculate it from 500. Are you able to interpret the question? So expected employees become 500 multiplied by 90% over the period of 3 years. That makes it 364.5. I am rounding it off to 365 employees. So the expense to be booked. Now this is a change in estimate. Earlier we were expecting 429 employees, now 365 employees. So we are going to check the cumulative expense. Try to understand cumulative expense. Whenever there is a change in estimate, we try to determine the cumulative expense that should be booked up to this period. So it will be 365 employees, 300 options. We don't change the fair value, 30 into 2 by 3 cumulative, because 2 years of period have lapsed over the period of 3 years. So 365, 300, 30. The expense that should be booked till this point is 21,90,000. This is the cumulative expense. But now we want to know the expense for year 2. So that will be 21.9 lakh minus, you have already recognized the expense of 12.87 in the preceding year, right? In the preceding year 12.87 is already recognized. So the differential amount will be expensed off in current year, 9,03,000. That is how change in estimates work. Okay, so we never book the expense based on actual number of employees, because we are not expecting that they are going to complete this service condition. So we are not going to receive any service from them for these shares. Now, what happens next year? Number of actual employees 300 who have completed the vesting period of 3 years. And anyone with a logical mind management will say, yes, we have received the service from these 300 employees. You have received the service. Okay, you have received the service. So there is some amount that is received by them in the form of service, and there is some amount that is expected to be received from them in the form of calls, exercise price, right? So now the expense to be booked will be 300 employees, 300 options, 30 rupees of price. This is the total expense that should be booked. That makes it 27 lakhs, right? But of this, some amount has already been booked in the form of expense, that is 21.9 lakh cumulative over the period of 2 years. So expense for this period is 5,10,000. So what is the journal entry that we are passing each year? First year employee benefit debit to ESOP outstanding 12,87,000. Next year again employee benefit debit P&L to ESOP outstanding, other components of equity 9,03,000. And the third year again employee benefit debit to ESOP outstanding 5,10,000. Over the period of 3 years, the balance of ESOP turns out to be 27 lakhs. If you add all the three figures, or that is where from which we subtracted the amounts each year. So 27 lakh is the last figure that will turn up at the end of third year. And then the employees are given the option that the exercise period of 3 years, as we had discussed, on which we are expecting in 2 years it will be exercised, you can buy the shares now. That is the option that we gave them. But they'll have to pay rupees 100 for these shares, right? We will continue this question. We will continue it with question number 3 to understand exercise part. 120, 170 employees exercised in 12, 13 and 14. So let's see what happened with these 120 employees. When these 120 employees exercised the option, they ended up paying you for each option 100 rupees, right? They ended up paying you an amount of 36 lakh rupees to buy the shares. Now what is the journal entry that you will pass? It is a very logical entry. Cash account debit, you have received 36 lakh rupees. 120 employees, 300 options, 100 rupees. Now we had this ESOP account that was made, that is the service that is received from the employees to buy these shares, and for each employee the value of the service was determined to be 30 rupees as expense by us, right? 30 rupees, and that is what we had accounted over the period of 3 years. So ESOP outstanding account that we have created over the period of this 30 rupees shall now be accounted for these 120 employees who have exercised these 300 options, and each option had a fair value of rupees 30. We need to now debit it. So that is 10,80,000. To share capital, to share premium. Now these 120 employees exercising 300 options means they have already purchased 36,000 shares. Let's say face value of each share is 100. Let's assume random figure. Either they'll give you in the exam or they'll not give you. Okay, they have given you rupees 10, so I cannot assume 100. We'll take it as 10. 3,60,000 goes to your share capital, right? Because these are the shares that have been issued. But what was the issue price? Issue price is not 100, it is 130. You determined that intrinsic value, if you remember, right? Exercise price was 100, I gave you fair value of the option to be 30, I told you intrinsic value of the share is 130. So for company, the shares price is determined to be 130 and we don't change it subsequently. So for us the price is 130. Actually what goes in share premium is a balancing figure. It is very easy to calculate, which is 36 lakh plus 10 lakh 80,000 minus 3 lakh 60,000, which is 43 lakh 20,000. But I can even calculate it. 130 is my issue price, which is this 130 of ESOP, minus 10 was the face value. For 120 employees, 300 options. So if we take 120 rupees, 120 employees, 300 options, makes it 43 lakh 20,000. So I hope it is somewhat understood of what has happened. Okay. This is what happened in the year 2012. Now what happened in 2013? 100 more employees have exercised the option. 100 more employees. So now again you have received some cash. 100 employees, 100 rupees for 300 options. That makes it 30 lakhs. Again we will debit the ESOP outstanding account because that is where we have booked 30 rupees of employee expense. That makes it 9 lakhs. To share capital, 3 lakh, 30,000 shares are issued to 100 employees, 300 options, and the balance goes to share premium, 36 lakhs. So even if I try to calculate it, it is like 130 minus 10 for 300 options, 100 employees. So 120 rupees currency unit multiplied by 300 multiplied by 100 makes it 36 lakhs. What happened at the end of third year? 70 employees have exercised the right. 70 employees, each of who pays you currency unit 100 for 300 options. That makes it 21 lakhs. Then we have this ESOP outstanding to be debited, 30 rupees, 30 INR for 300 options for 70 employees, 6,30,000. To share capital, you issue 300 options to 70 employees, 10 rupees, 2,10,000. To share premium, 130 minus 10, it can be a balancing figure as well, 70 employees, 300 options, 25 lakh 20,000. You can even check whether it is a balancing figure. So 21 plus 6.3 minus 2.1, 25 lakh 20,000. Finally, the whole period of 3 years has lapsed, excise period has lapsed. ESOP account should go up to 0, no more excise options will be given to the employees. So if we check this complete story, we have seen 120 employees exercised at the end of first year, 100 at the end of second year and 70 at the end of third year. Total turns out to be 290. But the amount that we had booked in our ESOP was for 300 employees. Now that's where somewhat trouble turns up. What? For 300 employees, you had booked for 300 options 30 rupees of ESOP value. That is how 27 lakh was arrived. But now you have only debited the account by 290 employees, 300 options, 30 rupees each. That makes it 26.1 lakh. So there is a difference of 90,000. We can even cross check. We'd start with 27 lakh, deduct 10.8, 9 and 6.3. From 27 we deduct 10.8, 9 and 6.3. We get exactly 90,000. You can always cross check. Now what to do with this 90,000? How are we going to account for this 90,000? Now we need to understand the concept of share forfeiture. If you remember, whenever someone applies for the shares, he pays you some cash and then you make calls. If he pays the call, fine. If he does not pay it, we forfeit his shares. And whenever you forfeit the shares, the differential amount, this share forfeiture, goes to general reserves. In short, we can say other equity, right? Here, the employee has given you some service. He has not given you cash. He has given you some service for buy of these shares. As good as cash. So he gave you service worth 30 rupees. He gave you service worth 30 rupees. Now you make after 3 years a call to him to pay 100. You have provided service, we have received service worth 30, fine, now you have to pay us 100 rupees. He does not pay you. You forfeit his rights. Where should this forfeiture go? Other equity, right? General reserves. So that is what we are going to do with this 90,000 as well. What happens at the end of third year is ESOP outstanding is debited by 90,000 and we transfer it to retained earnings or maybe other components of equity. You just mix it under retained earnings as 90,000. We don't transfer it to P&L. We don't credit it to P&L as our income. This is not our income. We were supposed to receive service from the employees. IFRS 2 ended at the point at which vesting period was over. After that, we were just applying normal share-based accounting. Nothing to do with IFRS 2. This 90,000 has nothing to do with IFRS 2. Why should I credit it to P&L? It is not our income. How is it this an income? We received some service from the employee and we did not give them anything. Are you saying this is your income? Bit illogical. Doesn't make sense. So that is why it is transferred to retained earnings. So I hope you got the logic behind how the questions are being solved, what is change in estimates, how we book the expense each year, and when vesting period is over, how actual expenses are booked and how share issue expenses are recognized. Okay, so with this we end this part of the video as well. Thank you.